So now shifting the discussion to capital markets.
Yeah.
So with capital markets rapidly expanding in terms of size and asset classes, SEBI is more and more becoming an active regulator. In fact, now India is the fifth largest country in the world with an equity market capitalization of around 4 trillion. So how do you see the regulatory space developing and its impact on the development of capital markets?
Right, right. And I think target to be is the third largest economy in some time, right? Just to take a cue from what you just said. The fact is that SEBI is a regulator. I think we need to remember that fact, right? So I think there are two parts to this. One is there are going to be regulations which come in, the way I look at it. So one is regulations which will come in to promote investment, which will open up asset classes. So whether you look at in the last couple of years, the promotion of the online bond platform or SME listing, which came in as a, AIFs, et cetera, or now in the more recent, which has been mentioned by the SEBI chief, is the day zero settlement, instant settlement as it is called, MF light regulations for passive funds, all right, which are basically less onerous, less cumbersome, and then the actual MF regulations, for active funds. So these are going to be great, I think. Or even very recently, you talk about the REIT regulations which have come in, for fractional ownership, right? So you're seeing a slew of regulations come in, which are going to be sort of great for the investor. For example, if you look at who could think that you're rolling a small part of a mall as a retail investor with maybe a 10 lakh ticket size, right, at the end of the day. So this is going to provide liquidity, further avenues for investment. So I think that's one part that's going to come in and you're going to see this. The other is that the regulators, aspect is a watchdog. So whether you see the recent, action against finfluencers, right, at the end of the day, that is for protecting investors. I think you've seen a slew of regulations come in, fines have happened, et cetera, right? And I think the fact that SEBI wants to mention is that, there is a regulation in place and one needs to follow it, right? Because, today anybody opens up a broking account. I think SEBI regulation came in last year, which says that 9 out of 10 people are not making money in the derivatives market, right? You're losing capital. So one logs in today, that's the first sort of pop-up that comes, right? Which informs the investor. Now, I think SEBI is doing its job to do some of these things, right? Whether it's like the recent, regulation with the offering that to invest in the FNO segment, you may need to pass an NISM exam, right? So I think that's the other part. So I think we're going to see that mix come in where you see one aspect is more and more regulation towards asset classes getting opened up, for HNIs or for retail with a lower ticket size. The other is the whole aspect around being the watchdog to ensure that, yeah, hey, I'm watching you and let's make sure that we do things in the right way. And I think that's what the role is, right, at the end of this. So I think
Uh,
it's a great time.
so moving on to the next question. That's a there has been a lot of debate on India, particularly given the unfair sovereign credit ratings or so-called unfair sovereign credit ratings. What is stopping the global rating agencies from upgrading India's ratings? And if that happens, what benefits would we see at the macroeconomic level? So, in fact, the decision of JP Morgan to add Indian government bonds in the GBI Emerging Markets Index starting this June. So will this help our credit rating cause?
I think, first, I think let's understand this whole credit, sovereign credit rating, how it works, a bit of the history. That's very important to realize the background. It is a very, question which needs to be dealt with in certain depth, right? So obviously, I think some of us know the S&P rating is like a triple B minus, which is just above junk grade for
Yes.
India. And that itself is a bit of a debate, right, for India. Now, let's even step back further that why is rating important? Rating is important because of two things, getting money and your borrowing cost, right? So inflows and borrowing cost even for a sovereign entity, right, at the end of the day. Now look at the stark things that never in the history of the world as a fifth largest economy been given such a low investment grade rating, right? And second thing to note is that India has never defaulted in its history ever, ever, right? Now, to understand that, these foreign rating agencies, whether it's an S&P or a Fitch, which rate us and some of the others, What are the parameters? The parameters are GDP growth, inflation, government debt, fiscal deficit, political stability, rule of law, corruption, your ease of doing business, external debt, your sovereign default history also, right? A lot of these things. Now, uh, but typically when you do a credit evaluation, there are three aspects, right? And the biggest being your ability to pay, which is do you have money, and your willingness to play. So if you have the money, are you going to pay me for it? Right? There are two aspects to it, right? Now, uh, if you look at the fact that our willingness to pay, we have never defaulted, right? So we've obviously got that willingness to pay as an entity, right? Now, to look at our ability to pay, now two, three aspects. One, we've always had good foreign exchange reserves. The other part is that most of the debt India has, it's in own currency. We have very limited or low foreign currency debt. So the likelihood of that happening, that ability of play not coming in is extremely low. you know. And if you look at, the commentary that India keeps getting from most of these rating agencies, there's that, that a fiscal deficit is high in the 5 to 6% range. Uh, and rating agencies, typically some of these, they apply the parameters of developed economies to India, which is a 3% deficit, right? Typically, you want to look at, right? Now, when you look at a 3% target number, and if you look at some of this number that we are going at, right? The fact is there's going to be a different outcome at the end of the day. So the fact is that should there be a yardstick which is different for emerging markets, that's the question which comes in. And if you see, this is very well documented actually. There's a lot of literature over the last 10, 15 years, where a lot of people have pointed out that this is not the way to actually assign credit ratings to a lot of these emerging markets, given the stage that they're in. You cannot be really comparing them to developed markets because there's going to be a large scale capital expenditure for infrastructure projects, etc., which will arise to a higher fiscal deficit. But are these entities not really sound? Is that the question? They are at the end of the day. Now, the other part which comes in is a lot of these parameters which go into these ratings. There's a set of objective and a subjective parameters. And the subjective parameters itself, that there has been, and this is also very well documented in literature, that the subjective parameters itself are not possibly being dealt with in the right way. And emerging markets are typically at the receiving end, you know. Uh, and all this is and this reliance of this subjective data and all this is very well documented in literature in the last 10, 15 years by various countries across the world, not just in India, right? And we need to appreciate this fact, right? Now, so the fact is that this credit rating and the fiscal deficit number, I don't see the fiscal deficit number moving drastically. Maybe we'll get it lower year on year, but getting to 3% is going to be a journey. It's not going to happen so soon, right? And if you look at what's happened, so obviously one should us coming into an index. I'm not too sure how much it will impact the credit rating. Yes, hopefully inflows will automatically come in because that's one of the things that happen once you get into a index. You automatically see a large scale inflows that start happening into any entity, right? Um, you may want to look at, for example, China and Japan. What have they done? They have in fact set up their own indigenous entities that do sovereign ratings internally. Japan has its own, China has its own, not just reliance on, the S&Ps and the Fitches and the Moody's of the world, right? So India may need to move in that direction. And you need to also understand that the position that the rating agencies are in, it has to be also, thought through because suddenly you change the whole rating mechanism. It's not a one country getting impacted, but a slew of countries getting impacted, right? So it's a complex problem. I'm not, but at the same time, I want to appreciate the fact that the whole justification of India being triple B minus is not there, frankly, and this is fairly well documented, like I have said, right? Obviously, if India's rating improves, there is a massive, improvement that you see in terms of flows because there will be so many funds coming into India. You'll just by virtue of just portfolio allocation, right? By just virtue of getting included in NICE, it's a portfolio allocation, right? So that's what I feel about this aspect. I think this whole has various parts and we need to deal with all of those in separate buckets at the end of the day. Yeah.
So, our next question is about this corporate bond market. So, despite India's growing corporate sector, its corporate bond market remains underdeveloped, placing a heavy burden on banks and NBFCs for the corporate financing needs. What factors have hindered this development of this bond market, and are there signs of improvement? If so,
Right.
what key areas should be addressed to strengthen this market?
Right. So if you see, I mean, first is, has it been improving? Yes. In the last 10 years, I think the size of the market has increased 3 times, the corporate bond market, right? Now, but at the same time, we're a fraction of what a bond market is compared to what a US is. We'll be, in terms of numbers, we'll be possibly a single digit, in terms of percentage. If they're 100, we'll be possibly in the low, single digits, right? That's the difference we're talking about, right? And why is this happening, right? Now, the fact is there is low foreign participation in the markets. Liquidity is a big issue, if you see, right? Most of the liquidity today exists in the government GSEC market, right? Which has got very heavy trading. But if you look at the corporate bond market, no, it's not really evolved, right? And liquidity is a big issue in this market. We are absent in global bond indices. If you see, I mean, this like what Vanshu you mentioned in the last, that getting a part of our bonds in the global indices, yes, it's going to be a step in that direction, right? And I think you've seen, like, for example, a year and a half ago, SEBI introduced a regulation where they sort of decreased the, I mean, private placement bond, that investment size from 10 lakhs to 1 lakh. That's a step in this direction. There was an online bond platform provider framework set up by SEBI about year and a half ago, right? I think that's also a step in that direction, right? I think to evolve, you need more and more of these things coming in, right? Obviously, there is a sign of improvement. You also need, for example, a CDS framework, which needs to be there, right? A credit default swap framework, which is there. I mean, while obviously CDS is, received a lot of its bad press around the Lehman Brothers crisis in 2008, and some of you may have studied it, right? Obviously, we're not talking about over leveraging yourself, but the fact of the matter is, if you do have a CDS framework within the with the right bells and whistles, it is an important part. You need to have credit enhancement frameworks that exist in the economy, market makers, right, which need to happen to improve liquidity. I mean, there is, given the stage we are at, you expect possibly this market may double in the next 5 years, but I think there's still a long, long way to go. And like I said, these measures which are needed, some of them which I mentioned, to improve and strengthen the bond market, yes, we need to have it. I think you need to ensure that corporates get access to funds, right? And a very good uh, corporate bond market is a step in that direction, because because ultimately large corporates, they will need this money. And why do they raise? They raise at the end of the day for mergers and acquisitions or whatever the case may be, right? But you need to have access to these kind of markets. Otherwise, you go into external borrowing, which has its own set of issues. But why not have a very well developed bond market? And it's not as if it can't be done. India, given the stage it is at, but doubling in 5 years is looks like happening, but definitely, which is, I would say I would say 10-12% growth rate at best, when you look at compounded. But I think a lot more needs to be done to ensure that this market gets evolved further, and it's sort of comparatively, compared to the developed markets of the world, becomes far, far bigger than what it is today.
Okay, so a follow-up question to this. So now that you have talked about from the institution, from the government and the regulation side, could you talk about a bit from the investor side? Like globally, who are the investors who invest in corporate bonds? Are they retail investors or institutional investors? And what is the mix, and why are investors in India not that interested to invest in the corporate bond markets? Is it just the availability that market is not developed, or returns are also an issue?
Yeah, so I think two, three parts. One is the international markets, obviously looking at large corporates, pension funds, sovereign funds, etc., coming in and taking exposures, right? These are the bigger entities that take, exposures into the market, right? At the end of the day, now you need to have a lot of these, coming into India. Obviously, that gift city regulation and etc. A lot of these comes in today at the end of the day. But the fact is, these are larger sort of entities that get into this. right? And like I said, liquidity, etc., a lot of these factors, the announcement frameworks, the CDS, yeah, framework, a lot of these need to be there to ensure that you get it. Now, when you look at retail, which is the indigenous Indian investors, right? Obviously, the reason to get into a corporate bond is when you see better returns compared to, and obviously it has to be inflation plus, right? At the end of, and typically more often than not, you compare it with a bank FD or a similar, mutual fund, right? And when you go into a corporate bond, it obviously comes with a lock-in, right? At the end of the day, so you forego liquidity for certain benefits in terms of returns. That's the whole proposition which comes in, right? So you've seen the numbers coming in better over the last couple of years, but once you bring in liquidity, I think you will see better. So, for example, can I trade my corporate bond, which I bought 10-year bond after 2 years and sell it off, right? Because rates have moved. And maybe the bond I have taken advantage both in terms of return as well as capital gains, right? So I think there's a lot more that needs to be done. Um, when you're reducing investment ticket size, that's a step in the direction where you get retail investors into it. But you're not today a 5,000 rupee ticket size, right? Which is a right. If you can, then it's great, right? At the end of the day, to get into a corporate bond, right? But no, you still require a much larger corpus. So the fact is that some of these enhancement measures will ensure more and more retail local participation, if that be the question.
So, sir, taking the point on Gift City and sir, continuing the discussion of flow of foreign capital into India. So, the government is dedicating significant efforts towards the development of the GIFT IFSC as a world-class international financial services center. So, in fact, sir, it has been incorporated as a foreign tax jurisdiction, and it has a separate set of regulations through the IFSCA. So, sir, how will it, on what magnitude will it help in attracting foreign flows? And so one more point on that, that do you see Indian business houses setting up or shifting their family offices to Gift IFSC from other global centers such as Singapore?
They've already shifted some of them. I think they've already started, right? If you look at the asset managers, like, some of the mutual funds in India, like a Birla or, some of the bigger names, they've already set up shops there for either foreign funds coming into India or even foreign, investments which are, investing out of India, both ways, right? But the fact of the matter is that you need to understand the infrastructure of Gift City is like you're in an international water, right? And what earlier used to be done in a Mauritius or a Singapore, right, is now available to entities to do it itself in India. That's what we're talking about, right? Now the fact is that quickly, if I would even ask you as a student, you would understand that what are the benefits. Like it's like, yeah, I mean, you're in India, you have access to cheap labor, the costs are far lower, right? At the end of the day. To set up these entities here itself, you are then, in fact, using this as the advantage compared to, some of the other geographies, right? And obviously, with the regulations that they are, with the tax advantages, SOPs, you don't have to pay tax for 10 years, etc. Those are the aspects people are going to take advantage of. So you are going to see, and you've already seen, like a lot of these MF houses have set up shops there. You have seen international funds that have shops set up shop there. So you will keep on seeing people who are going to keep on setting up shop there to take advantage of these regulations, right? It's obviously going to take some time. But the proposition itself is quite strong. So, for example, we know ESG fund will set up there, to get into India, so a lot of these entities are going to set up shop and we are going to see movement. And some of it has already happened, by the way. I think it's just a matter of time when these entities become of scale and we start really recognizing them even further from here.
So, sir, on a lighter note, can we see it becoming like a Dubai in 10 years, like that
Possibly.
level of
Quite possibly, Vanshad. Quite possibly. I think the fact is that you may even see an IPO market come up there. For example, Dubai is developing an IPO market itself, right? In terms of listing and a financial market out there, you could see even more and more stuff come there. We're allowed to do stuff, right? You've already got some sort of banking regulations also there for Gift City, right? At the end of the day, where you can open up, entities there. So the fact is that I think you're going to see more and more stuff come in over there in the next couple of years, more and more.